Let me throw up this chart, which is really this key question of Fed expectations, right? Bloomberg Intelligence is expecting we'll see 4.5%, so another 200 basis points to go by March of next year. We spoke to Dennis Lockhart just a little bit earlier, and he acknowledged that perhaps 5% is also possible, although not his base case when it comes to the dot plot and those expectations. What does that tell you about how much of this is baked into expectations and how much we're just going to see that balancing act between how long they hold that level for as well?
Well, I think that is the big question that you just asked. The rate hike tomorrow is baked in, and I think there'll be a couple more hikes beyond that. But the hiking isn't really the news. The big question is, when will the Fed stop hiking, and when might there be some cuts in the cards? And I think a lot of investors are betting that, by the second, third quarter of next year, some of that will start to come into view. I think our view is that that's a little bit optimistic right now. The Fed's going to want to make sure inflation pressures are really headed decidedly lower before they start easing up. And the messy data flow we've seen lately suggests that it's going to be a while before there's enough confidence that that lower path is entrenched.
We're seeing outflows across almost everything, right? Is there a strategy, an opportunity that isn't just taking cover? Because you look at the likes of energy and trading volatility seem to be one of the few winning trades at the moment.
Certainly energy continues to do well because of all of the reasons we know around the disruptions in supply chains, disruptions in commodity markets out of Russia and Ukraine. And those, frankly, with the news we've seen over the last few days, are likely to get worse rather than better as tensions escalate. But I think the other place where investors can find good opportunities are in the credit markets, companies that have good business models, good, strong balance sheets, and will continue to be able to service their debts even through a downturn. Equity markets may see a little bit more of a challenging period because they're going to see their margins squeezed right now.
Could that mean that we could see some opportunities elsewhere, like investment grade or high yield credit as well?
Well, I think investment grade and high yield are places my colleagues are finding a lot of opportunities, particularly in days like today where there are some sell-offs. Again, because the fundamentals of the U.S. economy, we think, are still very strong. They need to weaken a little bit to cool some of these inflationary pressures, but you can find a lot of companies that have strong balance sheets, that have debt profiles that they'll easily be able to roll over the next 12, 24, 36 months. And in the same time, you've got banks that are ready to lend again once we've kind of hit the moment where we think the Fed hikes have stopped.
We have more and more U.S. Wall Street strategists warning about equity valuations, about earnings risk as well. Where do you find some of those defensive calls?
Well, again, I think equity markets are going to be under a lot more pressure than credit markets just because of the new pressures on margins. Valuations have sold off a lot, obviously, but when you compare dividend yields for an equity that may be facing headwinds to investment grade debt that's trading, with yields above 5% in some cases, that's a trade-off that's much harder for equities to live up to.
Christopher, the other big unknown is really what happens in China, right? Do you think the lowest of expectations are already set? And is there an opportunity for a rebound, for more positive news flow once we get through the Party Congress?
It's hard to imagine the news flow turning more negative from here, and I think there are a lot of hopes pinned on the Party Congress. What I would say, I think a lot of people are still focused on the property sector, because even if the damage is contained here, and I think that seems likely, I would say that with my fingers crossed, but the property sector has been a real driver of Chinese growth over the past several years, and that's not going to be there until the government not only stabilizes the losses, but actually injects more capital into that part of the economy. So I think we're concerned that those headwinds will remain, or at least they won't have the tailwinds to deliver an acceleration of growth from here. So maybe a little too soon for China.
After the Party Congress in China, we also have the U.S. midterm elections. What sort of geopolitical tensions or are you factoring into the markets right now as we head towards the end of the year?
Well, for all the drama in U.S. political elections, I'm not sure the markets can expect much change no matter what happens in the midterm elections. Even if both houses tilt Republican, they're not going to be able to unwind much of the Biden spending agenda so far or tax agenda so far. If for some reason the Democrats maintain control of the Senate, or perhaps I think in some scenarios there are some hopeful ideas that they would keep the House as well. But again, they're not going to be able to push through any significant changes to U.S. fiscal policy over the next couple of years. So I think markets at least won't be looking for that result for their next direction. The geopolitical tensions, obviously, with China, with Russia, those I think are going to be much more dynamic in terms of what they do to market direction from here.